Good evening. I'm Ocean, and joining me today are Eunice and Dingding. Today's news will be dividing into three crucial components of the Canadian payroll system that affects workers across the nation. We'll start by exploring the Canada Pension Plan, a cornerstone of retirement security for millions of Canadians. Then we'll turn our attention to employment insurance, a vital safety net for workers facing unexpected job loss or life transitions. Finally, we'll break down the often misunderstood world of income tax deductions, helping you make sense of the numbers on your payroll. So another way to get a payroll deduction would be having employment insurance, or EI. An employment insurance is an insurance run by Service Canada that provides temporary income support to unemployed workers while they look for employment. It also provides compensation to employees that are pregnant or sick. As you can tell, EI includes the term insurance, therefore we must pay for it to get money in return when we are not able to work. For the current EI rate, individuals must pay 1.63% of their gross income per paycheck to be eligible for the benefits provided by EI. Who is eligible for applying for an employment insurance? Well, first you must be a Canadian citizen or a permanent resident, and you must have worked for at least 420 to 700 hours in the previous year. And now, keeping in mind that for every type of employment insurance, we can receive up to 55% of our earnings per week, capping at $668. And I will be introducing it to you the 6 main types of employment insurance, which are regular benefits, where people can apply for regular benefits if they are being fired or laid out through no fault of their own. They can receive 55% of their income from 15 weeks to 45 weeks. And if a person is sick or cannot attend to work because of medical insurance reasons, they will be granted an allowance for 26 weeks, which is sickness benefits in employment insurance. And there is maternity benefits. If a person is pregnant, she can apply for EI and receive a subsidy for 15 weeks. And there are also parental benefits, where if a parent needs to be away or take care of their newborn or newly adopted child, they can receive a maximum of $401 or $668 per week for 40 or 69 weeks, depending on the plan that they choose. So if a person is taking care of their family members, which is a family caregiver benefit, they can receive a maximum amount of $668 per week. If the person that is critically ill or injured is under 18, so is a minor, the caregiver will be granted a 35-week period being covered by the EI. If the person is over 18, the caregiver will be given a maximum of 18 weeks being covered by EI. The compassionate care benefit is when a person is taking care of someone that requires end-of-life care. The person will be granted a maximum compensation of $668 for 26 weeks. So there's one tool that I personally recommend using is the EI Benefits Estimator. So it lays out the benefits of EI clearly, and it is simple to use. You can also use the tool to check if you are eligible for EI return.
Hi everyone, my name is Dingding. So today I'm going to talk about income tax deduction. So what is it? So income tax is a portion of your annual earnings that's paid to the government. Canada has a graduated income tax system, so your tax rate depends on how much you earn. Canadian employers typically deduct income tax from your earnings each pay period. So there are several common types of income tax: personal, business, corporation, international, and non-resident income tax. Here is the federal income tax rates for 2024. But for the provincial income tax rates, they vary across Canada. Here is a useful website link, and you can click on it and enter your province and check your tax rate. So you may wonder why we should pay it and where the money go. So usually these taxes are used to public service or enable governments to redistribute the resources. You and your children can have a better access to free education, medical treatment, as well as some social welfare. But what if you don't pay it? If you don't take steps to resolve your unpaid tax, The Canada Revenue Agency can take legal action against you. So the CRA will lower your wages, freeze your bank account, seize assets, or even worse. Thank you.
The Canada Pension Plan (CPP) is a program run by the government. It provides financial support to eligible Canadians for income replacement to contributors and their families in the event of retirement, disability, or death. CPP is a retirement pension which has to pay monthly and is one of the main sources of income for Canadians once they retire. The amount you receive depends on how much and how long you've contributed to your plan during your work years. The more you earn and contribute, the higher your benefit will be. The CPP helps ensure that Canadians have a reliable source of income after they retire, helping to replace a portion of their pre-retirement earnings. It is also a disability support. If a contributor becomes disabled and cannot work, the CPP provides financial assistance. Additionally, when a contributor dies, their family, spouse, or children may receive a benefit. To qualify for the CPP, you need to work and have made contributions deducted from your income to the plan. You must have made contributions for a certain number of years, typically starting at the age of 18. Contributions are automatically deducted from your paycheck by your employer. Self-employed individuals make full contributions themselves. You can apply for CPP retirement benefits starting as early as the age of 60, though your benefits will be reduced if you start before the age of 65. If you wait until the age of 70, your benefits will be higher than if you applied at 65. Anyone over the age of 16 who works in Canada, except for Quebec, and earns more than $3,500 per year must contribute into the Canadian Pension Plan. CPP are typically shared responsibly between the employer and the employee, as they both split the payment. Self-employed individuals will have both portions paid themselves. As of today, the 2024 contribution rate is 5.95% of the pensionable earnings for employees. Maximum pensionable earnings subject to the annual limit is $69,700. Some adjustments are early retirement before 65. Benefits are reduced 0.6% per month, 7.2% yearly. Delayed retirement after 65. Benefits increased by 0.7% per month, 8.4% yearly.
And that's a wrap for today. We've taken a close look at the Canada Pension Plan, employment insurance, and income tax deductions, three key elements that play a significant role in financial lives of Canadians. Now, understanding these components is essential not only for managing your finances today, but also for planning a secure future. Whether you're contributing to your retirement through CPP, navigating the complexities of employment insurance, or maximizing your take-home pay through tax deductions, being informed empowers you to make better financial decisions. Now, thank you so much for joining us this evening, and we hope you found this information valuable.